Nvidia is pretty much the most important stock in the market right now.
The exponential performance increase is AI.
However, what if I told you that it isn't what it seems? Nvidia is a fraud. Let me explain. It is August of 2023. Everyone and their mother were anticipating Nvidia earnings. Everyone knew that a huge move was coming, but in what direction? Back in May, Nvidia popped 30% after beating earnings and the market proceeded to rally for the next 2 months. What would happen this time? Well, everyone thought that Nvidia was going to move at least 20% in either direction. I personally thought it was going down since Nvidia is insanely overvalued after tripling in 7 months. However, Nvidia absolutely crushed earnings and the stock popped 10% after hours. However, Nvidia then proceeded to reverse all those gains and we actually closed up 0.5%. Both bulls and bears with their calls and puts respectively lost a ton of money. Even though Nvidia beat earnings, it crashed up to 18% afterward. It broke the illusion of a rally after beating earnings. I personally thought the S&P would actually break 5,000 by the end of September after this happened, but no. This shows how the supposed bull market is losing steam. August, September, and October have all been red. After the euphoric rise in stocks after the acceleration of AI in the first half of 2023, the market did have to take a bit of a breather. So what does this mean for Nvidia earnings in a couple of days? And don't worry, I'll get to the fraud part in due time. Well, we've established the fact that both calls and puts lost money. Why was that? Let's explain something important for the rest of the video. Back in August, everyone was expecting Nvidia to move 20 to 30% after earnings. Because there were real expectations for a huge move in the share price, people were willing to pay more for options in order to capitalize off of the huge move. This is known as implied volatility or IV. Think about IV as uncertainty. Before a catalyst such as an earnings report, there's a lot of uncertainty and people are anticipating volatility. Because of this, option prices go up. However, after the event, there is now much less uncertainty and the option price crashes since usually, actual realized volatility was less than implied volatility. This is known as IV crush. Let's explore this further. A way to quantify IV is to take IV's percentage and divide it by the square root of the amount of trading days of the year, which is around 15.8. Let's call it an even 16 to make the math easier. Let's say I buy this call in the S&P that expires in a week. It has an IV of 12%, so we can divide that by 16 and get 0.75. This means that the market is anticipating that the S&P will move around 0.75% per day for the week. This is known as the rule of 16. For instance, if there's a meme stock with 300% IV options, that means that the market is pricing in 90% moves in the stock every single day for the lifespan of the option. We've established that IV drops after earnings, meaning that you can still lose money with options even if you were right in the direction the stock was going. So, is there just no hope? No, surprisingly there is some hope. There are ways to be short IV instead of long IV by selling options instead of buying them. There are lots of strategies that aren't affected by any move in the share price but are affected by IV. Iron condors, iron butterflies, short straddles, and strangles, and the list goes on. Also, an important distinction when shorting options is the fact that time works for you instead of against you. Theta decaying the option over its lifespan is to the seller's benefit. Because IV drops sharply after an earnings report, I wanted to test a strategy that involves shorting options and see how it would perform. Here's my hypothesis. Nvidia is a fraud. Not in a general sense, but it is a fraud. Here's the thing. Nvidia's insane run in share price this year was symbolic of the overall market's rally fueled by AI. However, the fact that the market, and Nvidia specifically, didn't end up rallying after beating earnings by 30% shows that the facade of a rally is shattering. There are unrealistic expectations that are being factored into option prices, and these expectations will be let down after earnings. We can capitalize off of that by shorting the options. Here's how an iron condor works. I would recommend using iron condors when shorting options on a really volatile stock like Nvidia since they're much less risky than the alternatives. I'll explain later. It involves 4 legs. You sell an out-of-the-money call and then buy a call that's deeper out of the money. You do the same on the put side. Your profit-loss chart should look something like this. Both the profit and the loss are limited. Since Nvidia is pretty much a meme stock at this point, you want this. This is why we aren't selling straddles, which is the usual way that people short volatility. If Nvidia does end up rallying or crashing 30% after earnings, then our short straddles are absolutely screwed. You can potentially lose an infinite amount of money with them shorting options without a cover. I found this research paper that backtested buying straddles before a company's earnings report. As you can see, there's a consistent drop in the value of the straddle between the day of and the day after the earnings report. I know that 0.6% doesn't seem like a lot, but trust me, in a world where quite literally everything is priced in and it's pretty much impossible to generate alpha, it is definitely significant. Keep in mind that this factors in cases where the stock popped and crashed after earnings, meaning that you lost a whole lot of money. Since we are using iron condors instead of straddles, which is what is tested in this paper, we are protected against a scenario which has disproportionate losses compared to everything else. This means that this gap should theoretically be somewhat higher. Yes, it is not an infinite money printer, no strategy is, but I would definitely look into it further since it does seem to have some potential, and I want to use Nvidia as a case study for this. So that's that. Nvidia's supposed dominance over the market is a fraud, and we can capitalize off of it being a fraud by shorting options after IV crush after earnings. Make sure to keep in mind that, as aforementioned, this is not a money printer, and we're accounting for that by using iron condors instead of straddles. You can and will lose money with the strategy on an individual basis. However, based on the facts, doing this consistently should yield a statistically significant profit. If you did this a million times, you would be in the green. If you want my actual thoughts about how Nvidia's share price will react, I'll respond with I don't know. If you had asked me the same question 2 weeks ago, I would have said that it would have went down like 5 to 10%. We were in the period of market turmoil and the sell-off in tech stocks would have spelled disaster for earnings. However, now I'm not so sure. November has quite literally been a straight line up so far for the market, and Nvidia may keep that momentum, no one knows. Hey, I heard from Jerome Powell that if you like, comment, and subscribe, your portfolio will double tomorrow. Why not try it and see if it works? You have nothing to lose. Also, you can use the link in the description and pin comment and get $100 in free stocks by signing up for M1 Finance. Thanks for watching, and I'll see you in the next one.